Howdy, Jacob here. Today we're looking at PDD Holdings, or more commonly known as Pinduoduo. They are actually, I thought this was more of a Chinese based company, but they're actually based in Ireland. So I'm sure you've heard of them, relatively in line with the JD or the Alibaba. They're an internet and direct marketing retail industry with 163 billion market cap and 136 billion enterprise value. So very interesting to see that they, for being incorporated in 2015 and already having that kind of valuation is absolutely insane. But they've definitely grown like crazy. So they're already at 18.7 billion dollars in revenue in 2022, and in 2016 they had 73 million. So that's very impressive. I can't even. There's just not a lot of history here, so I don't know the you're gonna have to put an extra margin on it. You're gonna have to be a little bit more conservative, just to the fact that I really only see 2 years of operating margin positivity. I believe on the cash flow side, you are seeing actually very positive due to their change in working capital changing as much as it has, but still not the greatest history. Um, not the longest history, so it is going to be a little bit tough to do some valuation, but we're still going to go at it. Let's look at the balance sheet. So 21 plus billion in cash like liquidity through both short term investments and cash on hand, with just a little over 2 billion in debt, both short term and long term. So they do have 2 billion in short term debt, but they can just write a check for that with their cash. That's nothing, or reissue it through reinvesting back in themselves. I mean, they have a lot of options here. The balance sheet shows so much liquid assets that it actually outpaces their entire total liabilities here. So we see 17.1 billion in all of their liabilities in total, and they have over 21 billion in cash-like investments, very liquid assets. So very interesting to see that they heavily reinvest back into themselves. Which, when you have a rate of return that's most recent, you're 27%. By golly, you're getting a great. That's a great use of cash there. They haven't issued a whole lot of shares, or they haven't repurchased any shares, and their stock-based compensation is already $1 billion. So they are seeing, they're increasing almost a percent a year from just stock-based compensation. Their shares outstanding is increasing about a percent a year, just based on that stock-based compensation. But no repurchases going on, at least from what I'm seeing here. Um, the use of cash is just fully reinvesting back in themselves. It looks like, which, if you get a great return on this investment, that's like an Amazon or a Tencent type of company, which we've seen exactly how those companies have performed, and it's absolutely impressive. So, um, those are the types of companies that I would very likely be missing due to my conservatism, but. Um, you have to be realistic as well. So don't just be like, this is going to be the next Amazon and pay whatever for it. There's still a price to pay. So let's start making some assumptions here. Revenue side, I mean, for being 160 billion market cap, there's still only 18 billion. I say only relatively, right? So 28 billion in revenue, and they've just been growing like crazy. I still think that there's a lot of growth ahead of them. Um, Oh, they are the Timu people. Is this that offers products and categories, cosmetics, sports and fitness, and auto, and Timu, an online marketplace. Oh, okay. All right, interesting. Revenue growth side, I mean, they're going to be growing like absolute crazy. Let's say 20%. That might sound weak based on what you're seeing here, but again, the bigger a company is, the harder it is to grow, and even 20% is a phenomenal revenue growth, year over year change. So maybe you could say that's conservative, but to me, I think that that's still a very powerful amount of growth. On the margin side, I think that it looks just crazy high. I don't know why I don't know how they're getting the types of margins that they're getting. I'm very impressed by that. I might, they're reinvesting back in themselves. so much that I don't know how they're being as efficient as this. I know when Amazon and Tencent are reinvesting back in themselves. I mean, Tencent was getting some solid margins, but Amazon was almost breaking even on the margin side due to just flushing everything back into the business. So that's interesting to see here. But let's do a bigger range here. Let's do like 20 and 30% share change. Let's do like 2%. Let's do 1% issuance. Terminal PE. I mean, probably pretty high. I would presume. I think at the end of 7 years, 20. Does that sound reasonable? Yeah. All right. So this is gonna be tough. Businesses that don't have a long history, and you are assuming over anything over 15% revenue growth per year over the next 7 or however long you end up doing your own analysis for. It's just very difficult to really be confident in those types of assumptions because they just don't have the long history of for sure reinvesting at those rates and for sure being able to, they're not like Microsoft who has a cloning history or Nvidia who has the crazy innovative history where they just kind of go into markets and it just seems to work out like crazy. There's just not that long of history to see. And so, yeah, I mean, I got to do a deeper dive on this company. Um, I think this company has more growth than a lot of the other ones in this thought process, like the JD, the Baba, the Tencent. I think it's definitely small enough that it still has some very thick growth out of them. But yeah, I'm just gonna have to do more research on this and hopefully get back to you in not too long. And hopefully you enjoy the video and have a great rest of your day. Thank you.